And welcome back. Canada's finance ministers are pushing ahead with a proposal to gradually increase Canada Pension Plan premiums and benefits. And joining us now to make sense of it is Nick Bontis, award-winning professor from the DeGroote School of Business. Always a pleasure having you with us.
Hi, Taz.
Hi there. Well, let's talk about the current system and how it works, if you wouldn't mind.
Well, the current system is that approximately 9.9% of your salary, up to about $47,000, is contributed to this pool. And you probably notice when you get your pay stub, get a little CPP line. Right. That's what it is. And it's jointly contributed. So the employee puts in and the employer puts in. And that's typically how it works. And what they're trying to do now is reform it because there's just not enough money in the pool. See, we have a demographic bulge now of older individuals who are about to retire. And of course, the younger individuals who are paying into the system can't offset those disbursements. So that's part of the reform process. We need at least seven provinces, to agree for the increase, and that's basically the plan.
So when you talked about younger Canadians kind of getting a bad deal on this, could you explain more? Because our population, senior population, is expected to double to 10 million over the next 25 years, and that's a very large population to support.
Yeah, the problem, Taz, is that what we're trying to do is increase the pool of money so that everybody has an opportunity to get the benefits when they retire. Unfortunately, right now, since the pool is getting smaller, the younger generation is going to have to increase their actual payments into the system. So as I said earlier, it used to be a 9.9% up to $47,000. What the governments are trying to do now is increase that portion, probably higher than 9.9%, which means that the younger generation is actually going to be paying more, and in the end, when the time comes to retire, they're probably not going to be able to get as much out of the system as they're putting in.
So I can understand why businesses would think that this is a bad move. Clearly, they're not going to want to watch a higher premiums.
Right.
But what's the best thing for young people to do at this point? What's the best vehicle to put their money in, if you will?
Yeah, absolutely. Well, I mean, it depends on where you are in your age profile. So individuals who are in their 20s and 30s, they're supposed to be in what's called growth mode. So what you want to do is invest your money, make sure that the capital, the underneath money, grows as much as possible. If you're in your 40s or 50s, you should be in balanced mode. So you have some growth vehicles, but as well as some interest-bearing vehicles like GICs and bonds and what have you. And of course, individuals who are in their 60s or 70s or above, they're in what's called capital preservation mode, so they should not take any risk with their investments at all. They're looking for interest-bearing vehicles like guaranteed investment certificates or even dividends that actually come back from blue chip stocks.
Now, for people who think that pensions aren't worth it, given what you've said, there are still some very good selling qualities on those pensions. Maybe you could list them for us, starting with they go with you. Doesn't matter what job you move to.
Yeah, absolutely. And this is what's happened. I mean, historically, for decades, you know, it was always the government that was going to take care of you upon retirement. And this is what we've been dealing with for decades and decades. And just recently now, in the last couple of decades, we've invented these new retirement vehicles like your RSP or your RIFs or your RESPs or even corporate pensions. And this is the same pattern that exists not only in Canada but in other countries around the world. So of course, we were talking about Greece a lot recently. That's part of the problem that they're having. There's such a rich pension that was promised to individuals at such an early age. You know, 54, 55 years old, you were getting a full pension that the younger generation, and there wasn't enough population of them, couldn't afford to pay out the rich pension that was promised to those individuals.
That makes sense. And speaking of young people, is there an age at which you recommend people start putting into their retirement? Because I think the stats say that an alarming, what's the number here, 93%? Two-thirds of Canadians don't have a pension plan or a retirement fund, and that's shockingly scary.
I do have an age, Taz, and you know what it is? It's yesterday.
Really?
That's the secret. It is never too late and never too early to start planning for retirement or for your investments. You know, the rule of thumb that you hear in the marketplace is put away 10% of your salary right from the top. The secret is don't even look at it. Pretend you never saw it.
So that's gross or net, 10%?
That is actually the gross.
Okay.
So 10% is really the minimum. So if you're getting $500 on your paycheck, take the $50 off and assume you're only getting $450 and put that away. And unfortunately, that 10% rule is not really a hard and fast true rule because it really depends on cash flow. We've had this discussion many times, Taz. You got to figure out what you can afford in terms of how much money's coming in versus how much money's coming out. But that 10% should be the minimum for everybody. And you're right, in terms of age, start yesterday.
And that's right, your first job. When you turn 16, maybe 17, get a job at the mall. You want to start thinking about that. Well, with so much economic uncertainty out there, a lot of people looking at bonds and thinking this isn't the way to go. I'm not making the same kind of return on my investments. What would you suggest to people out there who are scoring squirreling away that money, but not seeing the kind of returns that they want.
Okay, I've got some investment advice tips,
Excellent.
Taz. I got 4 things that I'm going to tell everybody. The first piece of advice is make sure it's simple to understand. That's the first thing. It's very, very important when you're investing in any sort of vehicle. If it's getting too complicated, if you can't explain it to your mother or your grandmother, then you really don't know what you're investing in. If you got complicated words like prospectus and futures and options and currencies, it's way too complicated. Understand what you're investing in. Number 2, income generating. What that means is that you want to invest in something that actually pays out a little bit of interest so that you have some cash flow. That's very, very important, especially for the elder generation. Number 3, transparency. Transparency means understanding what it is. Honesty. Are you actually getting into a legitimate investment vehicle? If you go to a bank, you can trust a bank. If you go to Mr. Joe down the street and he says, I got a great investment idea, give me 50,000 bucks, that might not be really transparent. Be very careful. This is your hard-earned cash we're talking about. And the last one, is it reasonably priced? This is very important because a lot of people don't realize, even if you buy a mutual fund, for example, and some of you are interested in no-load mutual funds, you just go to the bank and put your 500 bucks into a mutual fund. Everything has a price. Even a mutual fund has what's called a management fee. It's 1% or 2%, and that money comes out every single day. You have to understand what are the fees, service charges, and redemption charges. All this information is available to you from Harvest Portfolios.
Now, can you shop around?
Absolutely, you can shop around, especially with banks. If you have all of your money in a primary bank, you want to go there first because, of course, your financial advisor is going to give you good advice. But as soon as you leave that primary bank, go to the bank across the street, see if you can get a better deal with better fees.
That's good advice. Well, of course, coming up this Sunday is Father's Day. Happy Father's Day to you.
Thank you.
You're a dad of 2 children, I understand?
3, 2 boys and a girl.
3 children.
Yeah.
Wow. Well, I don't know what they have planned for you, but a lot of people looking for ideas on what to get dad out there, and you're a big tech guy, so you've got a couple ideas on what dad might like.
Yeah. Well, the hottest gizmo out right now is Microsoft Xbox Kinect, and I think we actually have a video clip of this. Taz. Let's take a look at this. So this is actually an amazing new technology where you can move around. It's got a 3D camera sensor, and it actually looks at your body. So these people are jumping, for example. You can imagine being in a sword fight. You can imagine playing in the World Cup of Soccer against Cristiano Ronaldo or having a boxing fight with Evander Holyfield. So this is the latest and greatest in terms of games technology.
Yeah, and if you haven't noticed, there's no console there, so nothing to hold.
No.
And I understand it's voice activated as well, so that adds another dynamic. Other than that, how is it different from, say, the Wii?
Well, the difference with the Wii, of course, was that you actually had to hold the Wii handle, and it was a little bit of restriction because most of the movements had to be with your hand with that Wii console. You couldn't do stuff with your foot. You couldn't, you know, head the ball or kind of shake your booty or anything like that. But with a 3D camera, you can do any sort of movement with your body. It's going to be an amazing thing for fitness as well.
Any idea what sort of price point this comes in at?
I have no idea, but most of the games that are coming out by Microsoft or Nintendo or Sony are in around the $300, $400, $500 range. I would expect that this one would be at the same price point.
And it's out right now?
Nope, it's going to be coming out soon.
Okay, any practical applications for this as well?
Absolutely.
There's some interesting things it can do.
Absolutely. I'm thinking of long-term health care facilities, for example. You can imagine individuals wanting to get a little bit of exercise and doing it in a fun way. Physiotherapy, people who've been in accidents, people who've perhaps broken their leg or have some muscle issues and really want to get back into it from a physical perspective. This would be a great game for them,
now,
too.
It actually adjusts to your lighting and your temperature preferences. So if you had, say, an iron out, it would know, sense that a child was coming up to it, and it would turn itself off so that the child wouldn't get hurt. It can do some amazing things, so not just the play aspect. Anyways, I think it's on sale, comes up for sale in December. I don't know when it comes out in Canada, but certainly one to be looking at. And it'll also be available for PCs, for you PC users out there. Okay, well, that's a wrap for Bontis on Business Week. Thanks for joining us, as always. And be sure to check out his website. That is nickbontis.com. Thanks so much, Nick.
Thank you.